Good morning, good afternoon, good evening, yWhales, wherever in the world you are. So today it's July 14th. We're kind of in that crypto summer, crypto winter. Not entirely sure where it's going. Bitcoin's hovering right around that it's turned into a $20,000 stable coin almost. And I'm here with Brandon from MEOW. And I had never heard of MEOW before this. Lily, thank you again for another amazing intro. But I'd like to kind of go back, and before we get into what Brandon's working on today, I always like to know where these came from. And Brandon, I think, is an exceptional entrepreneur in the Web3 space that spent quite a bit of time doing some really groundbreaking work that seems to be the precursor for a lot of what we see today in various stable coins and other protocols. And so, Brandon, I'm going to kind of jump over to you. And what was your first kind of exposure to cryptocurrencies, blockchain technology, and what kind of got you thinking that, like, hey, this is worth me spending some time here?
Yeah, so I was presenting at a security conference in Vegas, and I was intro to the Winklevoss twins there. And this is back when Gemini was only 50 people. And they told me about what they were building. It sounded innovative. It sounded like it could be the future of everything. So when you have the opportunity to be like the second security engineer at a major exchange, you jump on it. So it's a very early security engineer at Gemini. Great time there. Worked on the Gemini dollar, which was the first regulated stablecoin at the time. And yeah, it's just been all crypto ever since, and I'll be in the space for 100 years with everyone else.
So 100 years, it means you've been in it for about 5 years, because at the pace that we go, it ages us like crazy. So back then, I mean, stablecoins hadn't really been, weren't really a thing. And so what year was that you guys launched that?
That was it was either 2018
Okay.
or 2019.
So
Right in between
you're
those.
right in there
Yeah.
with everyone else. And there's no regulation at that point. I mean, there's it's just like, what do you do? How did you guys even approach that from a security standpoint? I mean, how do you guys say, what did you need to build other than just put it out there and peg it at $1? What kind of algorithms were you using?
The pegging of the dollar part is actually quite trivial. Anyone can spin up what's called an ERC20 contract and make a stable coin in an hour. But some of the considerations, there was actually some baked in compliance and security to the contract, in that if it went to a known bad address, say a terrorist had Gemini dollar at the time, we could actually strike that address, basically blacklist that address. And that's something that USDC has. It's something that the Paxos dollar has. But with great power comes great responsibility, as you know. So the ability to invoke that contract call was done via segregated addresses that are held in cold storage in different
Wow.
parts of the world. So that's like where the security kicked in, and Gemini was just top notch on security, everything. They really
That's
nailed it
fabulous.
there.
So that's interesting to think about, is that, again, we know that these protocols exist. We know that UST and USDC can, or not UST, they're not around anymore, USDT. And I always like to
Yeah,
give Terra, I've, or Tether, a little bit of credit, because we always thought that they would be the stable coin that brings down the entire thing. And they've held strong. Everyone else is kind of, imploded with these algorithmic stable coins. But Gemini was not an algorithmic. You guys were a true, stablecoin.
that's exactly right. There was a dollar backing everything. Um, Algorithmic is just a totally different conversation.
Well,
You're exactly
let's
right.
take a second and talk about algorithmic, as long as I got you before we get into MEOW. What are your? I mean, I am a technologist by trade, CIO, so I understand the basics, but nowhere near your level of complexity. And the reason I just have never touched, I was very familiar with Luna. We were connected with Do Kwon. We heard him speak a number of times. I just didn't it didn't make sense. It's not that I didn't understand it, but I just go, why add this complexity to something that should be relatively simplistic?
I mean, there is an appeal to trying to make a decentralized dollar pegged asset. If it's decentralized, and in theory, there's not a single point of failure. The problem with these assets is that they're backed by volatile assets. So Luna backing UST, for example, that was destined to not be a good situation. And there were a lot of unfortunately, founders who didn't know much about crypto, who came into the space, and they were just smart enough to get in big trouble by taking people's dollar deposits and earning yield, assuming UST would always match $1. That's a terrible assumption. I mean, having a dollar liability to customers and in reality earning USD on the other end, that's just a nightmare scenario. So yeah, I'm not super bullish algorithmic stablecoins, especially when they're under collateralized or backed by a volatile asset. The dollar backed ones and treasury backed ones, are much more palatable, and an innovation, a huge innovation, I think.
No, and I agree, and I think that it's one of those things that it's hard to impede on the government's turf of having their own stable coin of which they're determining what that's backing. And so when you kind of bounce into this weird thing of, especially like Bitcoin, I love Bitcoin, everybody loves Bitcoin, there's no one that's going to argue that Bitcoin isn't amazing, but it's extremely volatile, and it's still very new. And I think that's my question, next question, just kind of leading into is, I live in a world, when I don't compare Web 3 to Web 2, I compare Web 3 to Web 1. And because it's such a kind of entirely departure from anything that we've seen before, and the nuances of it is still like we're at the very early bleeding edge of what Web3 will be. I still believe that the best uses for it have yet to be invented, and I love what you guys are doing, and we'll talk about that here shortly. But I kind of like to, and you're probably a little bit younger than me, it really feels like we're kind of in that like 93 to 95 era. That people understand that something's coming. We're playing around with the technology, but we haven't had that true, adoption. There's what is there, 1.5 million Ethereum wallets on chain with 1 ETH or more. If you drop it down to 0.1 ETH, it's only 7 million. So it's a fractional tiny number of real adoption. Is that what you're seeing?
Yeah, historically, the product market fit for crypto has been speculation. So Coinbase was a vehicle for speculating on prices of assets and trading. OpenSea had product market fit on speculating on NFTs, for example. But that's where stablecoins come in. Stablecoins and DeFi, I think, are really changing the game here. And this is putting aside Bitcoin for a second, because I think Bitcoin's incredible. It's its own asset class, obviously. But stablecoins and DeFi, I think, can usher in the real kind of S-curve adoption for a practical use case unrelated to digital store of value that people can use right now, and it's only going to get better. That can onboard, the 7 billion people on the
planet. And so I think, again, this is a really good conversation about like, why are stablecoins important before we jump into what you're doing today. And to me, the reason that we saw, the crypto market go from $3 trillion, and now we're, I think we're about 900 billion. Still a respectable number for emerging asset class. But I feel like we've lost about $1 trillion. We should be sitting, closer to the 1.5 trillion, maybe closer to $2 trillion, if people had confidence in the stable coins. And as soon as there was just, and again, most people are degenerate gamblers that are in the space, and they don't have any actual education in what's going on. And so as soon as they heard the stable coins are depegging, they have no idea in their mind what the difference is between UST, USDT, USDC, or anything else that's out there. They just simply hear stable coins is broken, crypto's broken, and they rush to the exchanges and entirely go back to fiat, which is the exact wrong direction, that we're supposed to be going here. What do we need? What's kind of a few of the bullet points in your head that stable coins need to be branded appropriately, that provide the same level of confidence that someone would have as a fiat dollar in their traditional, Bank of America account?
So conflating USD with USDC or the Gemini dollar, that's an education problem. They're nothing alike in the first place. That, obviously, I know that. As far as, we've done a good job of self-regulating on the reserves of the Gemini dollar, for example. And I'm not a Gemini anymore, but I can speak to what they did. They did monthly attestations by an independent third party as to what was in the bank account, that everything was dollar backed. USDC has done a great job of that as well. I think Tether is working on improving there. But with regulation coming, there's rumors of regulation coming this year for stablecoins specifically. So I'm sure with that, there's going to be attestation requirements. There's going to be reserve requirements. For sure.
Yeah, and the regulations that are coming is number one, you're going to have to be tied to a bank. I mean, you're just going to have, U.S. Circle is already tied there. Tether's going to have to figure that out, and then you're going to have a lot of foreign entities that have done the work. That we're going to see kind of the New York problem, where they may just be barred from the exchanges being able to offer those stable coins. And I think, again, that's just to me the regionality or nationality of Web3 is what hurts it the most. I mean, it's U.S. is suffering, clearly suffering from I hate to say the word, but under regulation. Like you have to give us some idea of how you want to regulate this. Like if you want us to have a bank, cool, just tell me what we got to do and we can go get it done. But this living in limbo just causes innovation to go overseas. And I think that, clearly we're seeing a lot of that. We're going to have a great conversation about this. And so let's go ahead and pivot over into what you're working on today. And I'd love just a little lead up into, the problem you're trying to solve, and then how MEOW, again, I love the name, how MEOW is approaching this.
Certainly, yeah. So, I mean, we're so bullish on stablecoins, and this comes from our time at Gemini. We saw firsthand the profitable business models in Web3. The problem with Web3 is most people don't have that foundational knowledge from a regulated, US-based institution of these are the profitable ways to build a company. These are the practical use cases. So you see a lot of companies building solutions in search of problems. But one of the things we know is inevitable from our time there is that stablecoins are going to fundamentally change the way businesses and individuals pay for things. They're 24/7, they're global, low fee settlement. And the global part that I'm mentioning is the ability to send a stablecoin to someone internationally instantly and on weekends. You're competing with Fedwire and ACH. It's just a night and day difference. So that's really our vision, is to build the premier suite based on the financial rails of the future for corporates. That's still very much the play, and that's what we're very excited to build now.
I absolutely love that. I'll raise my
Yeah.
hand and say we desperately need it. One of my other companies is we have a real estate ecosystem that we do. So real estate, title, all the other stuff, and there's nothing more infuriating than you can't close because the banks have turned off the modems and they're like, nope, we're gonna take some time off. It's 3:05 on Friday. Everything's ready to close. There was a delay for whatever reason, and now that's just the end of it.
Yep.
And that's really frustrating. And I so clearly we're all in Web3. We see the problems and solutions. I sometimes feel like Web3 natives, we try to overcomplicate some things. Like, when I try to explain, why should a business understand what cryptocurrency is, or why a large corporation should be adopting Web3 technologies, they start talking about NFTs and DeFi. I'm like, what if you could just move money faster and cheaper? Like, what if it's just really that simple?
Yep. And if you really grill these people, they will not have an answer. Like if you grill them 2 or 3 levels deep as to why what they're building is actually useful for the average retail user or the corporate, they won't have an answer. But this is a real use case, and this is alone is going to change the world, is a stablecoin based payment suite. So right now, MEOW is live with free USDC, free buy sell. We're about to have gap accounting for corporates. No one's going after the corporate market because they didn't think it would exist in the first place. Retail's the early adopter for everything. Corporates are coming to the scene now, and there's literally no one going after them except for really us right
That's
now.
amazing. Yeah. And I mean, I'm watching, right now it's kind of streaming in the background. I've been paying attention. So Vayner, they just rebranded from Vayner NFT to Vayner 3. So they're all, web 3 now. And I think that's great. And I'm watching the products that they're debuting, and it's bleeding edge. I mean, it's so far bleeding edge stuff. And I think it's cool. I think it's amazing. And absolutely, I'm excited to see these things come out. But it's not even close to mainstream. The steps, like to me, the biggest challenge that we have is wallets. Like they suck, every single one of them. Coinbase's was garbage. Everyone's garbage. And so some of these things are really going to need to be solved, especially from a corporate level. And when you talk about corporates, we have different, I run businesses by trade and by profession. So I understand kind of the ethics and everything else you have to have there. Fireblocks, I think, is great, but it's $60,000 a year. That's a really heavy lift for most startups, and also the complexities of which you're a security guy. You can tell me exactly how complex these things are made and for what reasons.
Yep. Yeah, exactly. I mean, yeah, Fireblocks has great rails, but the average user, any corporate that's Web 2, even Web 3 companies, they have no business managing their own wallets in 99% of the cases. It's not a joke. I mean, we're going back to the days of like people carrying gold on their person, but that gold can be stolen remotely via a link. Yep. So anyone who's building like this for this future where like businesses own their own wallets and stuff, I don't see that happening. What we do at MEOW is you deposit dollars with us and your job is done. You have a team of security engineers in us that manage the complexity of the wallet behind the scenes for you, so you never have to actually engage with it. But that's not to say that there are a lot of potential customers for
talk me through this white glove experience you guys have, I guess, is the way I would easily phrase it.
I mean, if there's one thing you learn being at like the floor of a regulated exchange, which has all the users and the product market fit to date, by the way, is these exchanges is that people don't want complexity. They want a clean UI. They want to interact in terms they know, depositing dollars, and they want you to handle the craziness of sending on their behalf via a wallet, the multi-sig, the redundancy. So yeah, that's what we do. We make it easy for businesses that just want to send USDC at the click of a button after funding their account with dollars. I mean, that's going to be their experience the next several years. I mean, I don't see that changing fundamentally. Corporates even lag retail in this regard. So we'll see retail users owning their own wallet before we'll see corporates, but we won't really see either of those, in my opinion, for quite some time.
So walk me through the kind of process. And so a majority of people are listening to this are business owners. The number one question we get asked by our members when they join yWhales is, I believe something's coming. But I'm not entirely sure where I should look. And so we focus a lot on, kind of education, collaboration, and adoption. And so this is clearly in that kind of, adoption cycle of I'd like to be able to use cryptocurrencies, but Susie in accounting, like I can't give her a MetaMask wallet and say, here's a few $1 million of which you're going to be transferring over the next 48 hours. And please just put the hash rates in a spreadsheet for us to, log later. So talk me through that.
Yeah, exactly right. So if you fund your account on MEOW with dollars, you have the ability to buy, sell crypto, soon with GAAP accounting, and the ability to send USDC without needing to own a wallet or any complexity like that. You'll click a button, you'll say, I want to send 5 USDC to this email address, or if you're technical enough, to this wallet address abroad, to a contractor or something like that. And your job is done. You can wipe your hands clean of all the wallet nonsense. Also, what has gotten us here to date, where all of our product market fit has been, is offering potential yields to these corporates, working with lending desks. So again, they would only deposit dollars with us. They don't need to do any flips and tricks to source those potential yields. So your experience when you log in the MEOW is you deposit dollars into an interest-bearing account, which is just earning yields from a bank account. And from that bank account, you can choose our high yield offerings, which are powered by crypto. You can earn potential yields there. You can send USDC as easy as sending. I mean, it's the easiest way to send, frankly. There's Fedwire or ACH, and you can buy, sell from that same account, and your job's done.
That's amazing. So, and you're offering up to 4% yields. So thank you for having a realistic number. I love the 20% that others are offering, but I'd much rather be getting 3 to 4% and have it be there in a few years than earning 20% and then losing 80%. Because it's not sustainable.
Yeah, Jay, and that's the problem of the fundamental problem of the retail apps is that retail users tend to care about the highest yield possible. And that's in large part because they tend to be uninformed. You have someone who doesn't know crypto that well. They just see, I can earn 9% here. So then retail app 2 has to say, well, I'll offer you 10%. And the other one will say 11%. And the only way to have done that on paper was the Anchor protocol via UST. So that's why all the retail apps competing on the highest yields got in deep trouble. They lost a lot of customer funds, all of customer funds in some cases. So there are other sources in the crypto markets which do over collateralized lending, for example. And there are lending desks with very strong track records. We partner with those, the market makers, the lending desks, et cetera. And it's lower yield, but customers have to self-direct where they want their funds to go. There's no mixing and matching on our end, and they understand the risk profile very well, and they're inherently more conservative than by far than Anchor or UST.
Yeah, and that's really interesting. So, and you guys are not, are you on a specific chain, or are you kind of just wherever money needs to go is what you're going to do the most efficient ways?
So we'll actually send the dollars to the lending desks in USDC on Ethereum or just in dollars. And then they will convert to USDC, typically to their end borrowers. They'll make mostly over collateralized loans. But yeah, it's mostly Ethereum based. We're seeing the Solana ecosystem grow. I don't really have a thesis around that, but a lot of the product market fit in DeFi and trading activity in general is in Ethereum currently.
Yeah, but what you're saying is for the people that are coming to you, they don't want to. They're not interested. Ethereum, Solana, whatever you want to do, just keep their money safe and be good facilitators, ethically and morally of the funds, which is what I used to think a financial institution was. But there was then there's this new hybrid of financial institution mixed with a casino, and we're kind of seeing how that's working out long term.
Yep. exactly right. Yeah, I mean, Coinbase and Coinbase, for example, started with just Bitcoin, and they expanded to Ethereum, and then as more assets popped up, I mean, there's hundreds of thousands of assets listed on CoinMarketCap, I think. You list them, and it starts to resemble a casino. Now, there's a couple arguments to that. One is, people are individuals; they can make decisions that they want. They can speculate on whatever they want. The other one is, do you curate? We're currently we curate. We only list a few yield sources, and customers have to self-select. So it's the early days of lending and crypto credit markets. So it's the same kind of approach.
Yeah, and I think that's a really good point. I mean, to me, I'm always relatively disappointed when I see the big guys listing meme coins. And look, Web3 is permissionless, we're decentralized, everything else, but DeFi solves that problem. And if I'm sitting there with a fiduciary responsibility to both my shareholders, my clients, and my staff, it's as well as investors, it's really hard to say that I can allow my client base to feel like they're investing in a meme coin, which has unlimited, there's no cap, like Doge, like, listen, I'll get hate mail for Doge, but whatever the case is, like the issue is that there's no long-term viability of it. There's no ROI. So unless the entire world says like, look, all the value needs to go into this coin, of which there's a single founder that on his phone can just go ahead and generate as many more of these as he wants. He wants to buy a yacht. He doesn't need to give you any money. He's just going to go ahead and generate more Doge, cash out on the money that's coming in. And that's what the US government does. So I feel like we're impeding on some of their their play here. And, the idea that DeFi solves these problems, like if somebody wants to go get into a more volatile asset or go play in that casino, I think there's a time and place for that. And DeFi is maturing extremely fast. We're seeing the cycles come and go. I mean, Aave to me is like, it's as mature as you're going to get in the space, and they're just going to continue to grow and get better and better and better. I mean, you obviously share those feelings, but how do you feel that just kind of the overall asset class should be regulating itself? I hate using outside government regulation, but do you think that there should be kind of a pullback on these, true rug pull coins that do exist?
Yeah, it's hard to speak to them. I mean, where do you draw the line on rug pull? I mean, there's the blatant ones, and then there's the ambiguous ones which haven't lived up to their expectations. So that's tough. I will say on the DeFi side, like there was true product market fit through this cycle from the over collateralized DeFi protocols. There was no cronyism, there was no favoritism, there was no bankruptcy procedure waiting or anything like that. They liquidated or would liquidate anyone who didn't pay back. And it's dumb and smart at the same time because there's no person behind it.
Yep.
So these protocols like Compound and Aave. So Celsius paid back, I think, like you could see on chain some of the paybacks going there. And that's incredible because you know for a fact when you have collateral in DeFi, it's not pledged to multiple sources. That's something that could be done in the CeFi world. If someone pledges the same collateral, say it's a stock, to one party,
Yep.
and then also makes a promise to pledge it to another party fraudulently, you can't get away with that when it's programmatic, when Bitcoin is the asset or Ethereum's the asset. So that was true product market fit. I mean, there's a lot of confidence that grew from the Ethereum DeFi protocols there.
Yeah,
which is really great.
I feel like, and just as a conversational point, I feel like there's another level that these DeFi lenders need to really put into there, and it's a little bit of protecting the overall asset class, because when you've got a big liquidation coming, a bunch of future traders are getting liquidated, and all in one day, for years and years we've seen this happen where it's just like, we're coming up on Friday. It's clear that Bitcoin's not going to hit that number, and then we all got to go play the game. For those of us that are knowledgeable and watching this stuff, we go exit the market. We go in and we say, okay, let's go back to stables. 48 hours later, the liquidations hit, Bitcoin drops, or sometimes it goes with the buys, depending on what it was, shorts or longs. And then, you have to re-enter the market. And I feel like there's another layer of which can help offset that a little bit. But you're right. It's extremely efficient. There's no court proceedings. There's no nothing. It's like, you made your gamble, you made your bet. Now you lost. And by the way, here you go, you're liquidated. But it really adds so much volatility to the market.
You're exactly right. I mean, there's a lot of money to be made because of that kind of inefficiency. But directionally, as we see more liquidity, as we see more mature protocols, then those ARB opportunities, that kind of front running, yeah, we'll see that go away as well. But you're right; it's very early days still. The core, gears of liquidating without prejudice is excellent right now. So that's positive.
So what was your thoughts? Did you follow the Solend drama of their DAO and what they did?
Yeah, I saw the proposal. Yeah, I saw the proposal. I didn't study it too much, but I understand kind of
So
what was
let me
going
give
on with
a
it.
rough
Yeah,
overview as I understand it, and
yeah,
feel free to correct me. So
yeah,
Solend, there was a major whale that let's just say like 30 million, something maybe as larger than that, of Solana that was pledged. And they were, if Solana had gotten down to, I think it was like $22, would have liquidated, and it would have brought down the entire, would have been a big massive liquidation event on Solana, would have been a big kind of hit to the overall ecosystem. And with no terms and conditions, with no contract, with no rights or anything else, $500,000 worth of DAO governance votes on this protocol just went ahead and said, we're going to take over that wallet. We're taking over that wallet,
yeah.
and so we're going to pull it away from being able to be liquidated. And if it hits that, then we'll go through OTC ourselves to prevent it from hitting the chain. And there was this FUD of like it would have brought down Solana and destroyed the chain. And I'm like, you know what? They reboot the thing once a week anyway, so that's an irrelevant point. But what was your thoughts of kind of like a DAO of these really tiny minority shareholders that were hyperactive, and they were the ones that were watching this, being able to say like, no, we're going to change the terms and conditions on you without your knowledge, based on just their own fear.
Yeah, I mean, on a long enough timeline, you certainly anticipate that going away, even the capacity to do that. And if something hasn't changed there, then there's been a big problem in DeFi development, certainly. You can point to historical examples of this. I mean, Ethereum itself had a rescue fork in the DAO hack, and there were a couple other proposals like that where the benevolent government came in and proposed to change something that happened on chain effectively. So you tend to see that happen in the early days of protocols, whether it's a layer one or a DeFi protocol. You tend to see it happen. A lot of people voted for that in Ethereum world. I can certainly tell you in the long run that needs to be addressed. That can't even be a possibility for these DeFi protocols, and I believe that we'll get there
Yeah,
based on what we've seen to date.
perfect. So jumping back over to MEOW and what you guys are seeing, how's adoption going? How's when you give the pitch for the first time to some of these, I'm going to guess institutions or large family offices, large wealth managers. What's
Yep.
the feedback you're getting? What are you hearing around the industry in the last I'd say 90 days?
So you'd be surprised. Most of our customers are actually Web 2 companies, just standard SaaS companies. We're very proud of that because that was the intention, was to get people using us for potential yields without having to own a wallet, things of that nature. So in 2021, alternative asset yields were no longer a cute hobby. They were kind of a necessity for most corporate treasurers because of all the money printing taking place, because COVID kind of flipped the world on its head. So that's why we had natural tailwinds when we announced we had so many inbounds. And that's where we got like a lot of our customers, was those people seeing the inflation rates, seeing that interest rates were so low. So the sales cycle is actually quite short for those people. They're accredited investors. They have to understand the risks of where they self allocate their funds. So yeah, the adoption's been great on the Web 2 side, and that's kind of been the thesis the whole time. No one really thought that would happen when we started the company.
That's amazing. And so, which is also strange because, Web 2 companies generally, they feel like, oh, Tony and, Dev, he's in crypto. He can manage the wallet. And so they're basically being smart enough to say like, we believe the volatility and kind of the security of this is not quite there yet. And I'm going to guess that these are some relatively smart clients that are choosing to go with you guys in a 4% yield versus messing with it themselves.
Yeah, certainly. I mean, we have to, we explain the risk profile of every one of our offerings. It's not like we have our own closed book. It's not like you deposit dollars to MEOW and you just see like an interest rate and we're mixing and matching where we source it from. You actually have to deposit into the yield source for the potential yields that you want and understand the risk profile of each of them. Each of them is unique, but we do some curation, like I mentioned. So we're not providing super speculative stuff. It's mostly institutional lenders, mostly market makers, and very often over collateralized lending.
Interesting. And so, who's been the questions I pitch every day, and I get the same kind of questions about why this, why that. What are some of the biggest misconceptions that you're seeing as you go through this, that you have to every day kind of clear up? And this is a good opportunity to do it en masse.
explaining the difference between us and retail yield apps that were offering 9-10%. We do have to explain the difference there. And we tell people it's been our advice, and we have timestamped emails from this from a year ago, to stay away from some of those 10%, 11% offerings. I mean, some investors have recommended to us that we just put all of the customer funds in UST, don't bother with over collateralized lending. And we said, absolutely not a year ago. So there is a education problem, not just from the Web2 companies, but even from some of the Web3 quote unquote thought leader investors. Trust is a big thing here. In the absence of regulation, you have to find the trusted names, people with a track record, and that's something that we've really sought to be MEOW.
I love that. So in the world today, 4% yield, 18 months ago would have sounded like a dream compared to any other bank that existed. And unfortunately now we're, I think, what are we at? 9.1, 9.5% is inflation. And I've been saying for 2 years, it's closer to 20%. They're just going to slowly inch their way up there based on the amount of money they're printing. How do you, is it even a point of conversation of matching inflation nowadays? Is there even anything else that can be done to kind of stay that neutral point?
It's very difficult to match inflation. So what I'd say when you take on treasuries, you take on price risk, obviously. So what we're seeing for corporate treasurers is they're using MEOW as kind of a piece to the puzzle of their corporate treasury allocations. But yeah, now that interest rates are rising, then it makes kind of T-bills more attractive, for example. But matching inflation is going to be tough, especially because it keeps creeping up. There's questions about the legitimacy of the numbers. There are questions about when we'll get into double digits. You're exactly right about that.
Oh yeah, no, it's unfortunately most of these numbers, it's like, well, that's what they're willing to admit today, and whatnot. So I completely, again, it's mildly terrifying, and I'm happy to be in this asset class, because I do absolutely believe that any recovery, just like we saw in 2020, will be led by the cryptocurrency market, because there's just so much more freedom. But we have some groundwork that really needs to be dealt with, such as confidence in stablecoins, such as confidence in these exchanges. And to me, again, I say on almost every call, the wallets, no one's even come close. I've got my own vision for a wallet, and we're still messing around with some very nascent or very early technology on this stuff. And I'm not saying from a technology standpoint, I'm just saying from an actual oversight standpoint. I mean, when you have Bitcoin versus wrapped Bitcoin versus 4 levels deep of wrapped, I just feel like there's some things that are happening, and I always want to resist regulation. But we need to have some standards of which we all operate on. You can't just have people printing money out of thin air like Terra and Luna were, and just saying, well, this is just part of, it's just, now it's here, but nothing was actually created. It was just printed. And so that's kind of the concerns I have, is until we can really come back and pull way back on some of the things that were happening. Because, 3ACs and I feel for them and anyone that had money in there. They were just leveraged 10x, 20x on a lot of these investments. That wasn't any real money. That wasn't real value. That was just, there are a lot of people are going to go to jail over this. And so, I think where I come from is that we have the ability with the ledger, with the blockchain ledger, to know exactly what these things are and where they are. And I just don't know why we don't take that more seriously and more responsible, of saying great, it's fantastic you have a new protocol. Here's the basic metrics of which you have to build your bridge on, and the basic metrics of which you need to build your protocol on, that account for, all these things. And it's an argument I have all the time.
So I guess, where do you think the right amount of regulation is? Because there's oversight for the stable coins, which we all agree is an excellent thing. But then what about, so for example, when DM and Libra came out, Libra wanted to give anyone the ability to have an unhosted wallet, basically not known to the network, so without doing tier 2, tier 3 verification.
Yeah.
So I guess, where would you like to see every kind of address kind of known, with an identity behind it, or is it mostly on the CeFi kind of bridging to DeFi world that you want to see the regulation?
Yeah, I think that there's a regulated market. I think that there's absolutely room that you're just never going to see. Retail is going to do retail, but you're never going to have the institutions, the ones that do have fiduciary responsibilities to their shareholders and everyone else, enter an unregulated space. And regulation doesn't have to be a bad thing. And I'm just going to say right now that a lot of the stupid things that are coming out of multiple countries are absolutely asinine. There's no reason, there's no logic, there's no common sense, there's no education. So I always start with we need education right now, and we need a few thought leaders that are less worried about pumping their coins and pumping their protocols, and more worried about the longevity of this entire asset class. And that's the real benefit to me of Web3. So I'm not intelligent enough to answer your question, other than I believe
no, you're exactly right.
that I think that Bitcoin, the Bitcoin Mining Association, has done some really amazing things. And now that's centralization. I know that's an evil word to say, because we all want to be decentralized, do your own thing, and everyone love kittens and puppies. But the idea that you need a core group that's at least setting standards and saying, look, anyone can come play with us, and that's entirely fine. But here's what we determine is safest for investors, for retail, for institutions, everyone, just to adhere to. And KYC may or may not be part of that. The actual counting and auditing of these protocols may or may not be part of that. That's not for me to decide. But I can say that as business people enter the space and they ask these very same questions, well, who's monitoring this? I go, no one. No one.
Got it.
Well, what are the oracles? The oracles just do what they're programmed to. And I know numerous level one founders, and we have this conversation all the time. They're not going to focus on something that's not deemed a problem. They've got a lot of other, you're a security guy, you get it. There's a lot of things you need to stand up and deal with, because money being pulled out of bridges is a major problem. If your oracle is reading the exact same thing as 20 other oracles, why are you going to mess with it?
Yeah, and that's an interesting point. You mentioned the mining council, and I'm not taking a stance on this. My opinion is that Bitcoin's inevitable no matter what.
Yeah.
It's the only provably fixed supply asset. It's already digital. It's got the most integrity. There's not one person you can bully into changing it. Yeah. Having said that, so I think it's inevitable no matter what. I do agree with Michael Saylor that there's probably going to be even a quicker adoption cycle if there was regulation. It would probably going to go the way of kind of how people perceived lobsters in the past. Like these big institutions saw lobsters as kind of insects. Well, not institutions, but restaurant owners. And then it became a delicacy. You'll probably see the same dynamic with Bitcoin. Now, it's not the core ethos of kind of like unseizable, censorship-resistant money. And I think it's inevitable either way. But yeah, I don't think regulation will have a big problem on the blue chip assets, because they have a real purpose and they have real value props, and more people can access them in the U.S. And the U.S. is where all the capital is. That's where we can really hit adoption hard. So I agree with you there.
Yeah, and again, at the sake of upsetting everyone, I just don't think that Bitcoin is a great currency. I think it's a great store of value. And, if you think of it as digital gold, it makes a lot more sense. And it goes back to a lot of this. And having a digital currency is absolutely needed. But the idea, I'm a retailer by trade, and, I deal with a lot of businesses. And anyone that ever thinks they're going to walk into McDonald's and they're going to see a menu of 50 different cryptocurrencies, of which they can say, oh, there's my Doge, there's my Shibu, there's my Bitcoin, there's my, Cardano. Like, there is no corporate structure of which that will ever work, because at the end of the day, like the way that these things operate, and people have no understanding of how like actual financial systems work. At the end of the day, when that restaurant says, hey, I'm done for the day, and they're underwater on their sales for the day, like that's the last time you'll ever see cryptocurrencies. Like, they have employees to pay, they have staff, they're not gamblers, they're not investors. That's not what they want to do. So to me, DeFi really fixes that problem. You invest in whatever you want to do, and if you're getting 20% yields per day, and you're happy with that protocol, and you can instantly make payments, and it converts to whatever currency, stable currency of country you're in, and that's what the shop owner wants. Problem solved. Turning these volatile assets into a currency, maybe, but I don't know. That's nothing today. I mean, think of all the people that were buying Doge at 69 cents, thinking it's going to hit $1, and now you're down at 6 cents. And there was people that sold cars, that were selling homes on Bitcoin at $60,000, and now they're down at $20,000. And to me, that's the last time you'll ever hear these people or these businesses want to touch a cryptocurrency, because that was their experience.
Right. It's interesting. Some people do pay companies in crypto, but all those companies have the demand to instantly liquidate the Bitcoin or ETH and put it into cash. We actually provide that service to merchants. So if you want to accept crypto and have it instantly liquidated to cash, you can do that. But yeah, I completely agree. I don't see the Dogecoin being listed as a payment option long term and held in Dogecoin. Your liabilities, it all comes down to what your liabilities are to your employees and everything. in a hyper
Yeah.
Bitcoinized world, it's something a lot of people believe in, then Bitcoin is the end line.
Yeah, I mean,
Yep.
everything sounds good in a bull run.
Yep.
like we had the talk yesterday, and a lot of us thought, well, how smart we were, over the last couple of years, because you could just like, you only got a 3% increase today. Like, well, I got 15% increase over here. Like,
Yep.
everyone's winning. It's just at what pace are you winning? And even if you're losing, you're still exceeding, the inflation and doing better than most. And then we get into the bull, and it's arguable: are we in a crypto winter, or are we just taking another pause? Leading up to the United States midterms right now to see where the economy is going to go. But my next question to you really kind of pivots back over to the underlying technology that we're seeing. How early do you believe we are in the adoption cycle?
Extremely early. So to date, speculation was the number one use case for crypto, and that's where the product market fit was from the CeFi companies that are worth tens of billions. DeFi, USDC, international payments, that is a real business use case that is not tied to speculation in most cases. Certainly not the USDC payments. And I think it's going to change the world. So I think every kind of B2B suite is going to be based on that. It's going to be a core part of their corporate finance stack. So we're definitely early. I know you've been hearing that for the past like 5-6 years, but that's a good thing. And personally, like I'm a big Bitcoin bull myself, and you see that meme of like every year the criticism of Bitcoin is, okay, well, only scammers use it. Okay, only gamblers use it, and then okay, only small institutions use it. And now it's only small countries are buying it. I also see that trend continuing to grow. So very early days.
Yeah, and really the applause goes out back to Bitcoin during this entire thing. Like, of course it's going down, but I think if you actually look at the metrics of why Bitcoin is so far down, when you have corporate treasuries, and I truly mean corporate treasuries get hit by UST, a $40 billion just evaporate with the Terra Luna issue. That's going to cause liquidations, and what's the number one treasury item? It's Bitcoin. And so that gets liquidated, and that pushes the price down, that pushes the FUD. And then we get this double 1-2 hit of an incoming recession possibility happening. And so, I think it's, the technology has stood up. And the last point I'd like to make real quick on this is, proof of work is working. It does work. Bitcoin does operate. It is much more energy efficient than I think most people give it credit for. And so I really we can create a lot of things. We can do a lot of things in the space, but I think kind of really recognizing that the best store of value still to date is Bitcoin is something that needs to be recognized.
You're damn right, Jay.
All right. Well, there you go. That's a statement. So Brandon, yWhales, we're a startup. We've got a corporate treasury and all these other things. Let's just, give me the sales pitch. We'd like to talk to you about, using MEOW to manage a portion of our treasury. Walk me through kind of the intake and the experience that we could expect, for anyone else who might be interested in this process.
Sure. So yWhales is sophisticated. You all know what you're doing, and I'm sure you have reasons already to send USDC to people, to potentially have ETH in the balance sheet, to potentially have Bitcoin. So if you're just using a legacy financial rail company, putting all your cash there, it's a nightmare to have instant access to that. Your best case is an institutional account with a major exchange, and they're not built for you. They take you maybe 3 to 6 months to onboard. The UX is not for corporates. They thrive on the top 50 companies in the world and retail users. So there's this big gap for people like you, and that's where MEOW comes in. We'll onboard you same day. You have one cash account from which you can buy, sell, pay bills, send USDC, do it all from our dashboard, soon with gap accounting. So no one's going after corporates, and that's what MEOW is. MEOW is the corporate vehicle for your crypto needs, effectively.
So you said a length of time there, and I think that anyone who's listening may have just kind of blown past that, or thought that Brandon wasn't being realistic. 3 to 6 months for a company to get access to banking. Silvergate is kind of the gold standard, or whatever else. 3 to 6 months to open a bank account that has direct ties into a cryptocurrency exchange is absolutely correct. It took me 5.5 months and I mean, I'm not joking. They wanted to audit every single thing I did. They treated me as if I was, had been a terrorist. I've got, 30 years of banking experience and longstanding, not a single mark on my credit score, nothing. And it was almost that 6 month mark to get a bank account open. So you're saying that instead of me going through all that, we can have, MEOW just your bank account for us. You're managing that treasury, same level of oversight, ACH, crypto, whatever we need.
Exactly right. Fully compliant. We're US based. We adhere to all the most stringent of the SEC guidelines on everything yield related. So you're exactly right. And the reason we're able to onboard you so quickly is because we compound focus on the corporate market. Most others are not really gearing towards the corporate market. So an institutional account on an exchange like Coinbase, for example, they have no desire to focus on just startups. It's they want retail. They want the top 50 funds effectively.
Yeah, and also same thing. You gotta wait 3 to 6 months for Coinbase Institutional to say, oh, this is great. We'd love to get around to you. We'll don't call us. We'll call you.
Exactly.
And and so one of the other points I'd like to just make, and this is, and again, a question I ask, is in the Web3 world, there's still some things shaking out, and you have anon teams, you have docs teams, and I think docs is almost the same as anon. Like, it's great, we know your Twitter handle, it doesn't really mean much to me. And then you have fully KYC, internationally background check teams. Where do you guys fall into that?
But we really lean into compliance because that's the future of this industry.
No, and it's awesome. And look, I'm not saying anything about the ones that would be anonymous, and I've interviewed many anonymous founders, and they have their reasons. But to get corporate and institutional adoption, we've just seen the failures. We saw Olympus DAO, kind of get screwed over by that. We've seen a number of others. I mean, there's reasons for some people wanting to stay anonymous for privacy and protection reasons. I mean, a lot of young founders have never dealt with wealth, and suddenly they're incredibly wealthy, and they're scared. They don't know how to manage that. I think that's a perfectly viable reasons. Others that wanted to hide mistakes in their backgrounds, felonies and everything else, that's a tough deal. And I think that's something that anyone investing in your platform should be aware of. So we subscribe to that as well. So, Brandon, as we move into the my favorite section, alpha drop and everything else, not financial advice. Nothing here is financial advice. But you've been in the space for a long time. You're a security expert. You understand the core of blockchain, the technology behind it. What are you seeing that you just is kind of in the last 30, 60 days just really gotten you excited, and you go, this is just cool?
I'm going to bore you with my answer, and this is not financial advice, but just dollar cost averaging into Bitcoin, I think, is the right play. Some people are excited by like Ethereum, the asset as well. It is inherently more centralized than Bitcoin, in my humble opinion. But these blue chip assets, Ethereum has proved a lot of utility in the DeFi world, in the over collateralized DeFi world. It's done its job in this market. You cannot deny that. And Bitcoin is just a horse. It's a rock in a good way, and it's doing what every day it does what it promises. So if you want a asset with a fixed supply, I think it's going to be the commodity that everyone gravitates to. I'm a big Bitcoin bull.
So I love it. I love hearing that. So are you a Saylor kind guy? Michael Saylor? I love, we interviewed him a couple months ago, and he's like, oh yeah, Bitcoin's going to hit $1 million. And I'm just like, walk me through the metrics of is that hyperinflation? Is that like what has to happen for Bitcoin to hit 100,000, 500,000, and $1 million? And then Michael Saylor does exactly what he does. He just answered an entirely different question that he had in his mind. But in your head, being a maximalist, and you study this and you understand the core concepts, what are some of the key metrics that we're going to need to see? And forget the price. I can't guess the price, but what are kind of the core metrics and adoption, technologies needed for us to see this being really viewed as the world's, reserve?
I think it's all about comparison to gold. I think a 500K price for Bitcoin, you eclipse gold at that point, and this is just superior in every way, shape, or form. I mean, it's very true. It sounds like a cliche, but an asteroid can have more gold on it than the entire world. It takes, and this is something that Michael Saylor said, it takes 747s to send the same amount of gold internationally as it does snap of a finger with a Bitcoin transaction and value in a second. Mm-hmm. So when we eclipse gold, and that'll happen just progressively, like more and more people understanding. I mean, yeah, this year the criticism is that only small countries are buying it. That's night and day. This is beyond anyone's wildest dreams from even 2017, 2016. So it'll just naturally happen. I think it won't be all at once. I don't really believe in the all at once, but I think we're on the right track.
No, I can make all of you feel much better. My first exposure was early 2010, and I bought 100 Bitcoin for $20. Not because they were worth $20, but the guy who I was just talking to about it, he goes, just give me $20. I'll send you 100 of them. I said, great. And it was pre-wallet. You had to log into the node and go through all that. And when I was upgrading computers later, like the last thing I thought about was these random tokens, these random coins, of which had zero value and everything else. And for $100, I could have bought thousands of them.
Yep.
But the point is that it was so early
Yep.
in that adoption cycle that even if I had held on to them when they reached $20 a piece, $100 a piece, $1,000 a piece, I would have long since been like, I'm out. Peace. This was great. And so, anyone that's held on, I don't take OG status in any way, shape, or form. I saw it. I walked. I came back in about 2014, 2015. But anyone that really kind of saw the value of that long term is gets all the credit in the world.
So the thing about Bitcoin, which works in its favor from a regulatory perspective, is that it is kind of resembling a rock in that it doesn't move. It doesn't do flips and tricks on chain as much. Which makes it easier to keep track of and regulate. Now, again, I'm not taking a stance on that, but it just makes it more friendly in the eyes of regulators and corporates. I'm not at all taking a stance on that. Whereas you have a currency like Ethereum, that's Ether in Ethereum, that's going through DeFi protocols. It's designed to be composable and do things in DeFi. That's more difficult to track. So Bitcoin, Gensler already said that he's only confident saying in a video call that Bitcoin is a commodity. It looks like ETH is going to be called a commodity as well. I think it's wrong to, try to nudge any currency into like ETH as a security. But that's what Bitcoin has going for it. And I don't know that a huge lobbying effort is needed there because it is slowly finding its way into the hands of the powerful people in the US government, in different countries. I think we're on the right track with Bitcoin specifically.
I love it. I love it. That's Brandon with MEOW. To all the yWhales and everyone else watching out there, fabulous interview. Absolutely love it. Lily, thank you for the intro. Brandon, where's the best place for people to find you? Also to kind of learn more, and if they want to corporately onboard with you guys, or just for themselves.
Yeah.
What's that process looks like?
MEOW.xyz. Please visit. Please request access. We'll have someone reach out to you. You can talk to me. Looking forward to talking to everyone.
Well, I'm gonna sign up just because we want to try it, so I appreciate it. For all you guys out there, perfect. Thank you so much, Brandon. Hang out for a second, and we'll see you guys next time.
Thanks, Jay.